Picture the pitch. A guy in a hoodie, standing in a kitchen that is definitely not his, telling you he built a system that pays him while he sleeps. Rental property, Dividend stocks, a YouTube channel, a course he recorded once. He calls all of it the same thing, passive income. Set it up once, then step back and watch the money fall into your lap like rain. It is one of the most popular financial dreams on the entire internet. It is also, and I want to be precise here, doing something sneaky with the word passive. Because that word already has a real, legal, very specific definition, written by the government, decades before anyone filmed a kitchen like that, and it has almost nothing to do with no work. Today I am going to show you where that word actually comes from, what 4 different passive income streams actually cost in hours and dollars, and why the guy who arguably started this whole dream ended up in bankruptcy court. Quick thing first, because I have to. Everything I am about to say is general information and my own opinion, not financial advice, and I am not telling you to buy or avoid any specific stock, property, or business. Check every number against your own situation, and if I got something wrong, the comments are right there. I am a cartoon man with a round head. I have never once collected a dividend. And before you ask, no, I am not about to sell you a course on how to sell courses. That particular Ouroboros is somebody else's video. Let us go find out what passive actually means. Here is the twist nobody expects. The word passive income already had an owner before the internet got its hands on it, the United States government. In 1986, Congress passed a sweeping tax law and carved out a category called passive activity, written into the tax code as Section 469. It was not designed to describe a dreamy lifestyle. It was designed to stop wealthy investors from using paper losses on real estate to wipe out their regular salary on their tax bill. And here is the part that breaks the whole guru fantasy. The law says rental activity counts as passive automatically, by default, regardless of how much actual work you put into it. Read that again. A landlord who spends 40, 50, 60 hours a week fixing toilets, screening tenants, and chasing late rent is still legally passive, according to the IRS, unless they qualify for a narrow exception as a licensed real estate professional. So the very first thing to understand is this: passive was never a promise about effort. It is a bureaucratic label from 1986, invented to close a tax loophole for the already rich, and the internet just borrowed the word and quietly swapped in a much more flattering meaning. Okay, but even if the legal label is a technicality, surely owning a rental really is hands-off most of the time. Sort of. That is the honest, slightly annoying answer. Landlord workload is not a steady drip, it is bimodal. Long, quiet stretches where a rent check just shows up, followed by sudden weeks that eat your entire life. Look at what happened during the pandemic. Harvard's Joint Center for Housing Studies surveyed landlords nationwide and found the share of landlords actively taking steps to sell their properties jumped from 3% before the pandemic to 13% during it. Landlords were deferring maintenance, missing mortgage payments, missing property tax payments, all while smaller mom-and-pop owners were the least likely to even know emergency rental assistance existed. That is not a rounding error. That is more than 4 times as many landlords deciding the passive asset was not worth it anymore, the moment real stress hit. And it is not just the big, obvious crises. It is the Tuesday night text about a leaking water heater, the 3 weeks of vacancy between tenants where the mortgage still bills you on schedule, the background check, the lease you have to actually read. The quiet months are real. But the myth conveniently never mentions the eviction, the burst pipe at 11 at night, or the tenant who stops paying, because those months are when passive quietly turns into a second, unpaid job. Now let us talk about the other favorite. Just start a YouTube channel. It pays you forever after you upload it once. Here is a number that should be tattooed on every "quit your job and become a creator" video. A 2018 study by German researcher Matthias Bertel, analyzing YouTube channel earnings, found that 96.5% of people who try to become YouTubers never earn enough ad revenue to even cross the US federal poverty line. Not get rich, not quit your job, cross the poverty line. 96.5% fall short of that. And the view distribution is brutal. By 2016, the top 3% of channels captured about 90% of all views on the entire platform, up from 64% just a decade earlier. To land in that top slice and earn something like $16,800 a year, barely above the poverty line, a channel needed over 1.4 million views a month. Meanwhile, the bottom 85% of new channels topped out around 458 views a month. Total. And this is not old news. A 2025 Creator Economy report found that more than half of creators now earn under $15,000 a year, and that share is climbing, not shrinking. Set it up once and it pays you forever is real for a tiny sliver of creators. For everyone else, it is closer to a lottery ticket that also requires a full-time job's worth of unpaid labor to buy. If a belief just quietly died in your head, good. That is the entire job here, once a week. Subscribing is free. Staying wrong is weirdly expensive. Fine, forget landlords and creators. What about the cleanest passive income of all, dividend stocks? No tenants, no comments section, just money quietly landing in an account. This one is genuinely the closest thing to real passive income that exists. It is also hiding the biggest catch of all four. Right now, the dividend yield on the S&P 500, the broad index that most just buy the whole market advice points to, sits around 1.05%, roughly an all-time low, about half its typical level over the last 20 years. Let us do the honest math out loud. At that yield, generating $10,000 a year in passive dividend income takes roughly $950,000 sitting in the market. Want $30,000 a year instead? You need close to $2.85 million invested. Nobody selling the dream shows you that number, because it reveals the actual secret. The closest thing to truly passive income requires you to already have, conservatively, hundreds of thousands of dollars. Money that, unless you inherited it, came from years of extremely active, unpassive work and saving. Sure, you can chase a higher yield fund or a single dividend stock paying 3 or 4% instead of 1%, and that cuts the required pile of cash down by roughly a third. But notice the pattern. Every version of this conversation ends the same way, with a number, not a vibe. And the number is always a lot of money you needed before any of this started paying you back. Passive income is not the opposite of working hard. For most people, it is the reward you get after years of working hard, not instead of it. So where did this dream actually come from? One book, mostly. In 1997, Robert Kiyosaki self-published Rich Dad, Poor Dad, which went on to sell somewhere between 32 and 44 million copies. Its central pitch, boiled down, stop trading your time for wages. Make your money work for you instead. Assets, not a paycheck. That single idea seeded the modern passive income dream more than almost anything else in personal finance. Here is the twist inside the twist, and it is almost too perfect. In 2012, Kiyosaki's own company, Rich Global LLC, filed for Chapter 7 bankruptcy after a federal jury ordered it to pay $23,687,000 to a business partner over a contract dispute. The company listed roughly $26 million in liabilities against under $2 million in assets. The man who told millions of people that money can simply work for you, on autopilot, watched a single lawsuit wreck one of his own companies almost overnight. That is not proof his ideas were worthless. But it is a pretty loud reminder that even the guy who wrote the book on making money passive still had a very active, very stressful relationship with his own money. So let us put the whole story back together, because it is a genuinely satisfying shape once you see it all at once. The word passive was not born on the internet. It was written into U.S. tax law in 1986 to close a loophole, and it legally applies to landlords no matter how many hours they actually work. Real rental income is bimodal, quiet months, then crisis months that eat your life, which is exactly why more landlords tried to sell during the pandemic than ever before. 96.5% of people chasing passive YouTube income never even cross the poverty line doing it, and more than half of today's creators still make under $15,000 a year for it. The cleanest passive income, dividends, requires roughly $950,000 just to pay you $10,000 a year at today's rates. And the man whose book arguably started this whole dream watched his own company go bankrupt from one lawsuit. Here is the honest reframe, and it is actually the liberating part. There is no such thing as fully passive income. What actually exists is residual income, money that keeps paying you back for work you already front-loaded, the years of saving before the dividends, the months of filming before the ad revenue, the renovation before the rent check. The work does not disappear. It just moves to the front of the timeline instead of happening every single day. That is not a scam. That is not a lie. It is just a much less Instagrammable sentence than money while you sleep. That's the myth, busted. If you would like the next one delivered automatically, that is literally what subscribing does. No pressure. I will be here regardless. This was wrong all along. Go do the hard part first. The passive part was always going to